business.
So all sorts of discussions going on as to what's going on in the property market and how people, perhaps first-time buyers, can be helped to buy houses in a rising market. But reports today that the government is going to place what's called tight restrictions on any intervention in the property market to support first-time buyers. We have a couple of guests with us. Karl Deeter of Irish Mortgage Brokers. What do you make of this?
I think rowing back on what was initially put forward, or what we were told was going to be put forward, of some kind of loan guarantee scheme, is probably welcome news. I don't know that this type of intervention is what's required, because what they're talking about now is that if a bank would only give a person 80% of the value of a property as a mortgage, that the state will, put forward another 10%, but the person has to have saved 10%, added all together, you get 100%. But when a bank will only give you an 80% mortgage, there's usually two main reasons. One is because you don't qualify for the loan. So say if you were buying a place for 200,000 and you'd saved up 20 grand, but they'll only lend you 160. Well, then that's all you should be borrowing. And that's based on central bank stress tests. So if they supersede that, well, then what's the point in having a central bank? But the second time is when someone is buying a type of property that there's a known risk or issue with. So some lenders won't lend you 90% if you're buying in a rural area, or if you're buying a one-bed apartment in, say, Roscommon, for instance. They will pare back a little because they know that should something go wrong, that their likelihood of recovery on that loan is lower, or there might be a glut of one-beds in that area, or various other reasons. So I think that when we hear about these plans, the intentions are good, but the nub of the problem isn't to treat the symptom of credit. The nub of the problem is the number of houses for sale where people want them.
Okay, but what you're arguing there strikes me that the two issues that you're talking about, it's a protection of the banks is what you're talking about. It's not a question of what the consumer wants or whether the consumer is going to be safe. This is a question of the banks being unable to afford to actually lend the money.
I suppose it's also a case of protecting people from themselves, because if you put a situation forward that allows extensive credit to be lent, even when people don't qualify for it. And remember, the central bank is the one that determines the way that you lend in terms of the stress testing that goes on loans to make these final sums that you can borrow. Well, then you're really jumping over what the regulator says. And the regulator has a duty both to the lenders, but also to the nation, to avoid systemic risk and bad decisions. So it's a little bit of the bank protecting themselves, yes, because they have seen where they went wrong in the past. And when the bank gets hurt, quite often the consumer gets hurt. But you also have to protect consumers from making bad decisions.
Okay, John McCartney is with us as well, Director of Research at Savills Ireland, which is one of the biggest estate agents in the country. What do you make of Karl's analysis?
Well, I agree with Karl. I mean, in essence, if banks are not prepared to lend at a loan-to-value ratio of anything greater than 80%, then they're doing it because it's prudent to do so. So why then should the taxpayer be asked to cover a higher loan-value ratio? That, by definition, would seem to be asking the taxpayer to do something that's deemed by the banks to be imprudent. So,
but could you not put an insurance scheme in place? Isn't that what they do in countries like Canada, where you actually effectively insure your mortgage, that if the state was to provide support for somebody to get up to the 90% from 80%, couldn't an insurance product be put in place to cover any losses in the event of the property market turning down again?
Well, indeed, it is part of the system in Canada, and indeed closer to home, it's also an aspect of the Help to Buy scheme in the UK. But I think, moving away from the minutiae of the whole thing, the bigger issue really is whether the problem is really on the demand side of the market or not. I think the problem that first-time buyers are experiencing isn't one of lack of mortgage credit. We've seen that the value of mortgage credit has increased by nearly 60% in the last year. First-time buyers account for half of all the mortgages that are drawn down. So there really isn't a shortage of mortgage credit, at least not at this point. And the banks are telling us that the real problem is that people can't find houses in order to do the deals to draw down the mortgage finance that's available.
But sorry, John, doesn't that then suggest that house prices are going up? Maybe not in the rest of the country outside of Dublin, but if house prices have hit their bottom and if they're rising, doesn't that suggest that 90% loans are safe, given that we're not going to have another bubble bursting, at least in the next few years or so?
Well, they're safe for now, but of course that's in a context of no new supply being brought on stream. Clearly, when you've got the supply side of the market producing houses again, that will affect the trajectory of price growth. So I think ultimately, the solution to this problem is on the supply side. We simply need to be building more houses. You can't at the moment either rent or buy a residential unit in many parts of Dublin, and that is driving up prices. And as that drives up prices, it means first and foremost that people can't find the houses to buy, never mind worrying about whether they can get the finance to do it.
Karl Deeter?
Yeah, I suppose I have the advantage of working in mortgages every day, and I would say this, that having a deposit of 10% doesn't mean that you have the ability to repay a loan. Like if I had somehow amassed 100,000, it doesn't mean that I'd be able to pay off a loan of 900,000, because that would be 10% of $1 million. You still have to be able to fundamentally pay off the underlying credit that you've taken out. And the thing is, like, John just frames it excellently. I love his analysis because he just puts it absolutely as it is. The issue is with the supply of houses. Like, we are not seeing in our brokerage that people are not qualifying for loans. Now, some don't, of course, you'll always have some that don't, but the big issue is finding places they can buy. And rather than having a situation where, say, if everyone was hot, saying turn up the air conditioning more and more, really you should cure the fever that they all have.
But isn't it the case, John McCartney, we're unlikely to have a significant supply of new houses for at least a year, possibly 2 years, because of inaction on the part of the government and an unwillingness by the part of the banks to finance developers?
Yeah, I think that's probably an accurate assessment. Certainly, it's hard to see a pipeline of new development coming in to make any material change on the supply side within the time frame you indicate. I mean, I think, to be fair to the government, they had introduced some initiatives to try and, within the Construction 2020 document, for example, to try and improve that. But look, there's some very simple things that could and should have been done a long time ago. We have an example here of how the government cut the VAT rate on the tourism industry to kickstart activity there. That's been a success. If they did the same for residential construction, very quickly you would see the schemes that are currently marginal in terms of their ability to make profit for developers, they would come back into viability almost straight away, and that would encourage development.
Very last word to you, Karl Deeter, to finish up.
Yeah, that's a very important point, because cost of new housing has an implication of the price of second-hand housing. So if the cost of building a house is 100,000, but there's 100,000 of tax on top of it, and there's a house down the street that is a second-hand house, then they'll both sell for about 200,000. It makes a false price support in a way. So things like contributions, which is levies paid to the local authority, even though we now have local property tax, which is what contributions were meant to be in the past. Things like dropping the VAT rate. Things like getting rid of excess contributions for projects that aren't going ahead, like Metro North. There's a lot of things that we could get rid of, because 40% of the cost of a new house is in tax. So imagine if that was almost 40% cheaper, then you'd have a lot more affordability, and you wouldn't see things on the front of the Indo today saying house prices going up over €8,000 in a month, and you wouldn't have people scrambling to get on a ladder that could mean they're only making that decision to avoid huge price rises in the future.
Karl Deeter of the Irish Mortgage Brokers, John McCartney, Director of Research at Savills Ireland, thank you both very much for joining us. 53102 is the number for your comments. We will take the traffic.